So welcome to the last session of the VC module. Today we have with us Alan Roderman, Managing Partner of Exmon Capital. Today's session is about venture capital deal making and different tools. Do not hesitate to ask your questions to Alan by using the chat function or by unmuting yourself and turn on your camera. Also, don't forget that after the end of the module, you will receive a survey and also access to the recorded sessions. So welcome, Alan.
Hello. Hello all, I'm Alain Roderman, Managing Partner at Exmon Capital, and I will share with you what I know about term sheets and deal closing. Let me share the screen so that you will see the support of this discussion. So I've been in a VC for 24 years now. It's a long journey of hope and of happiness, and also very distressed situation with startups, because we live with the pace of these startups and the company's highs and low. And so you already got a pitch from my two partners the last 2 days, so I will not tell you more about what we do, but in the team, I'm the guy with the most knowledgeable about the term sheets and everything related to the deal closing. So we will go in this hour through a number of points, specific points. But please interrupt me with the chat, which I see on the side of my screen, so I will be able to answer your question right away. I will try to leave 15 minutes for question at the end. I'll do my best to let you speak also and share views or everything you would like to add to this discussion. So we'll go first to the syndications. Term sheet, it's about closing deals, and closing deals is about doing that with other people. Then we'll go in depth with the term sheets and the deal closing. We'll also cover corporate governance, so what's happening after we close the deal, and a few light summary for the main takeaways of this discussion. First, the syndications. So what is absolutely clear in venture capital is that VCs have a very big ego, and everything would like to be a leader, just because it's all about marketing as well, marketing yourself, marketing a firm, and it's very common that you have a number of people wanting to lead around. And what is leading around? I will cover that in a second. But syndicating means doing a deal with others. So if you lead, you need others. For sure, you are stronger when you are more VCs on board, because you have more brain power and you have more money, you have more time to help the company. So it's very important to syndicate. And this is what's happening in venture capital, is that most of the deals are done with a small number of investors. There are very special situations with VCs that are very big funds, that have huge issues to deploy the money. And in that case, they have a tendency to do the deal alone, especially at the very early stage. This is what I did in my past when I was with Sophie Nova in Paris, very big fund, and doing deals alone. It's also something interesting, but you are alone, and you cannot count to anybody else to help you in such situation. So now, just saying, what is a lead investor and a follower investor? So the follower is everything but a lead. So I will just spend time on the lead investor. So lead investor, most of the time they sign the biggest check. So it is, imagine a fundraising of 10 million of a startups, the lead investor would put 4 or 5, and there would be 2 others at 2.5 joining the round. They negotiate the terms, so they write the term sheet, negotiate the terms. I mean, most of the time, valuation is set by the big investors and all the secondary terms. So write the term sheet, have it signed first. And once it is signed by everybody, we have to go to the structuring of the operation, and the lead investors most of the time select its preferred lawyer and preferred auditors just to audit the accounts and audit the technology, audit the legal documentations. So once we are at the stage of writing the closing documents, the lead investors will review and negotiate the words that are in those documents. And in the end, the lead investors will always sit on the board of directors. And the others could have a board seat, an observer seat, or nothing else. So the common practices are the following. There are disadvantages to be a lead investor. When it goes wrong, it doesn't go to the right direction. There are ups and downs with companies, and sometimes the company needs bridge financing. Otherwise, it sees bankruptcy at the end of the street. So in such situation, everybody counts on the lead investor to put more money. So being a lead investor means you have sufficient financing power behind you in order to lead some bridge financing with the other investors. Being a follower don't give you all the time access to a board seat and nor an observer seat. So it would be difficult if you are a follower to just be very active on the board and get the information you need in order to fulfill with your obligation, for example, as a fund, or fulfill with the strategy of the fund, which would be to be very active in companies. And third, whatever the situation, all the lead investors and the followers have the same information rights, so which is very good. What can be negotiated is that the other investors, so the followers, could get as well the board packs. It is absolutely negotiable, and we'll come back on that later. So any question on this lead and follower situation? If you have questions, please ask me, and I will come back. So second point, it is about the term sheets and the deal closing. So I love this painting because it absolutely shows what is a closing. A closing, it's a kind of long-term deal in which you have already planned what will happen when you divorce. There are few sections about the way we will behave, but most of the lines, not the line of codes, but the lines, the words will be about what's happening at the exit time. So there are a number of templates of term sheets. I just wrote some of them here. You can find that on the internet, and you will see that most of them are very different. So there are a number of ways to write a term sheet, and what happens is that we use by copy and paste what was signed before. So it's practiced by almost everybody this way, and I will just give you a kind of a short story about that. I remember that, so when I was an investor in a VC fund based in Paris in '98, so it's a long time ago. At that time, there were just 4 VCs in Paris. And at that time, the shareholders agreement were 4 pages long. 4 pages. And the term sheets at that time were half a page. So it was a kind of intention letter. Would like to invest in your company at that price. So it was super light, and it was just before there was a huge push of the Anglo-Saxon practices coming from the USA and the UK in continental Europe. So what I did in '98 is my first deal abroad. So it was in the UK, and it was a fantastic deal named lastminute.com, and it still exists today, a company that went public very fast. And I just saw the first long-term sheet of my life. I said, oh God, what is it? So it was something like 5 or 6 pages long, describing a number of things that would be negotiated with plenty of protections. And I was so happy to see that I took it and I adapted it to the French market by changing words. And after that, so I remember, so I did a misspelling in the words I added. And these mistakes, these misspellings, were copied and passed for years, and in the 5 to 10 years after, I saw this part of the text in many term sheets in France. So just to show that people just build on existing things by copy and pasting and adapting it. So there is a question. I think that everybody can read it. Does the lead investor get a remuneration for his work? Before the investment and thereafter? So absolutely not. So this is one of the key particularity of venture, is that you are not paid to sit on the board. You are not paid for the due diligence you do. So it's very difficult to externalize the due diligence, what you see with private equity. We do it ourselves. We are paid to analyze. So we do the analysis ourselves. And if there are additional costs like a technical audit or financial audit or legal audit, it is taken, it is paid by the company when you show the invoices. So you are not paid for this work. So what I will do now is to show you an example of a term sheet that I took in the first link. So if you go to this this section, you will see that there are term sheets in several languages, and one is in English for England, and I will share that with you. So how do you determine who will be the lead investor? So this is, you will show your muscles, and if you are more convincing than the other, you will be the lead investor. This is the way it works. Most of the time, it is a local investor, somebody who knows the local jurisdiction, or it is the one that will put the biggest amount of money. But if in such situation, the guy putting the biggest amount of money is just 23 years old, it's difficult for him to be the lead investor, because you need a long experience in order to make it fly. But let me share. So I have to stop the sharing and share a Word file. Just a second. I'm stopping the sharing, and now adding a Word file. Where is it? Here. Okay, so do you see that? So it is a term sheet. So a term sheet is that long. I just show you. So it's few pages that covers the main points, and those main points are almost all the points that are tough to negotiate, except one that I will share with you at the very bottom. So I will just go through very fast. I highlighted in yellow what is absolutely key, and we will cover those points later in this presentation. So first, and overall, everybody thinks about valuation of a company. Just because we are paid to make money, so everything is about valuation. The lower you pay, the biggest multiple you will do as an investor. So it's going to be a tough discussion, and we will cover that in the very detail just after. For sure, when we close, we have a number of things that could be conditional. So most of the time, it's written that it is completion of a confirmatory due diligence. It means that it's not binding, because whatever could be seen, you can always say that you are not very happy about what you saw. So those term sheets are not binding. So we will go also through the type of securities. Most of the time it is preferred shares, but it could be as well convertible shares or kind of very light loan, convertible loans that we can, that do exist most of the time at the very early stage of financing of those companies. And after that, for sure, the liquidation preference is a very big thing. It's a way to align people, and I will also cover that in the very detail just later today. Anti-dilution provisions, it's about what we call the ratchet, being covered later as well. And also important decision, this is about the veto rights. So there are a number of veto rights that just counterbalance the power of the founders and the fact that venture capital is about minority investments. So without those veto rights, everything could be decided, and you could, as an investor, you could be screwed, completely screwed. We will go also in the details. After that, conversion to ordinary shares is not that key, and it's copied and passed just because sometimes you need to do that. Preemption rights, so preemption, right of first refusal, co-sell, drag along are all the provisions that we will detail that are necessary in order to make sure that everybody exits at the same time and you are not left on the side. There is also something absolutely key that we name the reverse vesting, or we name that reserve, it's written there. The reserve vesting provisions, it's about making sure that the founders don't leave. And in such situation, the founders have a big incentive not to leave in the first, let's say, 4 years. And this is a period that you absolutely need to take into account, and you put your money on the head of those guys. So you have to make sure that they will not leave. Then there are always a section of the board about the board of directors, what is going to be after the financing. I told you about the information rights. All the structured investors absolutely need to report, and it's due to the fact that they are supervised by the market authorities, the CSSF in Luxembourg, but the AMF in France and in other countries, you have the same situation. So you have to report. You have to report not to the authority, but you have to report to your investors a certain way. Now we have here the last point, but the first one about warranties is never detailed in a term sheet, because if you would detail it, the founders would never sign such a term sheet, because you will ask them to warrant a number of things. We will cover that as well. It's just a summary about what I'm doing now. After that, confidentiality and other things, it's not absolutely key. So it is signed for sure it should be signed by all the investors, all the shareholders. But if there is a very long list with angels on board, Sometimes you have 20, 40, 50 angels. It's starting to become a nightmare because most of the time, they are not here to sign. So we sign for them. And when we go to the documentation and we need to have them sign the new shareholders agreement because it's going to be drafted after that, then some of them, I would say 2 or 3% of them, a little bit more, maybe between 2 and 5% of them will start to negotiate, and some of them will never sign. And it happened to me several times. This is the reason why it is absolutely founders need to understand that bringing on board 50 small investors is a big issue for most of the funds, because we know from day one that we will have problems, and sometimes it could be huge problems because you need the signatures of everybody, and they will not sign. And again, it happened to me. Everything I'm saying, it's about experience. So this is it. So I'm stopping sharing this Word file. If there is a question, I can answer now. Otherwise, I go back to the PowerPoint. Okay, so I'm stopping. So if you have a question now, I can answer. Otherwise, I share again the next steps. That's it. We were here. Good. How can I? So this is what we shared. So now we go to the key terms that I already mentioned about the investment structures, evaluation, the liquidation preference, and the ratchet, corporate governance, and veto rights, and reps and warranties. If there are other points that you just saw in this term sheet that on which you would like to go in depth, just write it somewhere, and I will answer after I'm done with those main terms. First, the investment structure. So there are two types of deals that you see on the market. You have convertible notes or priced rounds. What does it mean? Convertible notes, you just wire the money, you are not a shareholder, and you are promised to convert your stake, I would say the money you wired, into equity later, with special terms, with a kind of discount. Most of the time there is a 10% or 15% discount on the on the price of the next round of financing. What is the big drawback of convertible notes is that you don't know what are going to be the terms, because it's not a term sheet. Everything we just saw is not written in a convertible note, because a future lead investor will set the terms and maybe will not be happy. But on the other side, it's very easy, very fast to materialize for a startup. So you have VCs getting in just to get a 15% discount, very fast, so it's very attractive. It is senior to any other securities. And what happened to me, to us, to our firm, let's say something like one year ago, a company in which we had a convertible loan. We are the only one to get that. With the arrival of the COVID crisis, just realized, because it was in the travel space, that we will never raise their fund. So they sold the company, a kind of fire sale. But due to the fact that the company raised a significant amount of money with preferred shares, we had on the top of that a convertible note. And our convertible note was reimbursed on as a seniority situation compared to all the other claims. So it was very good for us. So we took a risk because the company was not well financed. They just raised part of the money they just wanted to raise. So it was risky. And in the end, they never ended up with a real round of financing. And the last point on convertible is that it is sometimes very expensive, because the way it is drafted is that we say that it's going to be converted with a floor and a cap of, let's say, 50 million. So you already know that you will pay a very high price. So it means that you inject money, the company use your money to look bigger, to progress, to invest, and you don't benefit in large amounts to this growth. You just benefit with the discount, with the 15% discount, and it's badly paid. So this is like that, but sometimes when it's very hot, because the company is fantastic, in that case, we are almost forced to accept such situation. And price round, on the opposite, are capital increases with a specific price. It's super protective because you will sign a term sheet and you will absolutely deploy everything what was written in. So you will be very protected in the end. It's super good if companies are rising stars, just because you pay, let's say, 10 million as a valuation, and the company will progress very fast, and 1 year later it could be at 50 million. Look at what happened with Clubhouse. The company went over 1 billion in several months. So it's sometimes you are skyrocketing situations, and being in a price run in such situation is absolutely fantastic. But if you are not the lead investor and the company is raising 5 million and you can put 1, you are waiting for a lead. Sometimes you can wait a long time, because sometimes they never succeed. And they come back and say, oh, I cannot, can you lead? I cannot materialize, convince the lead, can you lead? And it is difficult to say no, but we should say no in such situation, just because it's not at all the same deal, the same risk. But if we fall in love with the company, we are sometimes tempted to say yes. Sorry. A question is, do you participate in a round with a mix of convertible notes and capital increases? The convertible notes come first, and the capital increase just triggers the conversion. So I don't see examples for which you have 2 in parallel. It's one or the other. But let's say the price one comes after the convertible notes, but not the opposite. You're welcome. Next, about valuation. So now you have to concentrate, because I think it's the the main point in discussing in term sheets. So I'm sure you know this guy. So if you know the guy on the right, please write it in the chat. And if you know these guys on the left, please don't write it in the chat, because everybody knows him. Absolutely clear. So these guys on the right, put a check on the table of, let's say, $100K. The name is Mike Markula. So invested in Apple as an angel, kind of lead investor. He took a board seat, invested this, and did a loan as well. It was not a convertible loan, but so it was a dual investment, and he made a fortune. So his initial investment is worth, or if you look at what it would be worth today, it's about several billions, if not dozens. It's not if not. It would be dozens of millions, if not hundreds of billions now. So Investing in equity in very promising companies is absolutely very rewarding. So valuation was in 1977, $160,000. Great. So what is the impact on valuation? So depending on the valuation, there is another of not provisions, but situations that are going to be triggered. On the right, first, for sure, the number of shares of the company will vary. If it's a high or a low valuation, if you invest 1 million at a high valuation, you will get less shares than at a low valuation. So the distribution of the proceeds in a sale will depend and will change depending on valuation. Second, you have the voting rights. Voting rights are very important because the veto rights most of the time are drafted and written depending on a percentage of votes. Let's say you need at least 66% of vote to trigger this and that. Most of the time, it is not given to a single entity or a single investor. So it means that depending on valuation, you can have the investors could have a bigger stake, and with this stake, they could easily put in place some veto rights. Otherwise, they could not. As an example, if a company is valued 100 million and you put 1, you would get a little bit less than 1% of the shares. And with that, it's almost impossible to have any veto rights. And, and last point, it is about the incentives. Incentives of the management. If you come on board and say, I'm putting 1 million and I will take 90% of the shares of the company, in such situation, management will just keep 10 and will be super demotivated. There is a kind of benchmark that comes from the long experience of the USA in doing VC. We always heard and we see that whatever the situation, the day of the exit, the management team and the founders have 20% of shares or more. 20%. So if they have less, they will be issued with free shares or stock options in order to keep them motivated. So the point is that every time you do a capital increase, the founders are diluted. And if they are diluted fast, they are not super motivated. So it means that even if founders come with 40 pages of business plan, they put on the table and you back them, valuation could be several millions just for 40 pages. And I think it seems not fair, or is it worth that much? And it's not the case. But in order to keep the motivation of the management team, in such situation, we will let them keep the majority situation, the majority position in the company. So valuation has a big impact on venture capital return. And just this graph to show you that the internal rate of return of funds go up and down depending on the vintage. And you have the vintages years that are on the bottom. It means that the date of the inception of the fund, and the fund lasts 10 years, but the investment period is 5 years. For example, a fund that started in 82, usually invested until 86 or 87. So this in 82, so for the best VC funds, it was 10% a year. But remember at that time about inflation, which was very high. And I started on my side in 97. So at the time where it was absolutely crazy on exits, and it was at a time where we were able to list companies very easily. It was before Sarbanes-Oxley event. It's not an event, but it was the name of a law that came and say, "Oh, starting from now, the board members will have a personal liability when they list a company if they lie in the red herring." The red herring is the IPO document. If they lie, so if you say, "I'm doing 5 million of revenues, but in 3 years I will do 300," but you already know it will never happen. But if you write that, you are liable against the lawsuits that could come. So I mean that depending on situation and the economic cycles, it goes up and down, and it varies a lot between funds, between let's say top VCs and let's say lower quartile VCs. Varies a lot. And look at
Alan,
that. I'm sorry.
Can I ask a question?
Yes.
On your last graph, was that height area? Was that the .com bubble?
Yes. Yes, absolutely. .com bubble exploded in 2000. So the funds that were able to list companies before the .com bubble had a fantastic return. But what's happening now, it's almost the same. I don't have the last numbers, but it's super good now for VC. Super good. On our side, in our small portfolio, we have 3 companies going public that have announced they would go public. One of them is Spire Global that announced yesterday, or the day before yesterday, on the 1st of March, that they would go public with a SPAC. So it's a very good period for VC because most of the VCs are focused on digital companies, and it benefited from the COVID situation compared to the others. Just to show you something, what does it mean to have an IRR? So funds are 10 years long. They are not exactly, the funds are not exactly drawn at the very beginning, but take an example of a fund lasting 10 years. So in 10 years, in order to do 3 times the money, 3 times net the money, it means it is 12% a year of return multiple. So funds that are talking about IRR of 20, 30, 40, it's absolutely crazy, and it's almost impossible to get. So this is why VCs look for IRR, reasonable IRR of 20%. So around 20%, it could be more if you are very lucky, but they are looking for that. So in order to understand what is about valuation, we absolutely need you need to understand the strategy of the VCs. And I understand that Jérôme Vitamer showed you that, or just gave you a few insight about this, but this is to show you that by mixing a portfolio of companies, of let's say 20 companies that have a different risk-return profile, you end up with a fund that has a specific risk return. And in that situation, if you look at the red curve shows at 50% probability that there is 50% chance of doing more than 2.2x net. So it's cash on cash. So you invest 1, you get 2.2 in return, net of everything, of carried interest, net of everything. And depending on the strategy, if you do early stage, late stage, for sure the risk return profile varies. And the most risky is the seed fund. In the seed fund, just in this simulation, it is shown that you have more than 25% chance of never returning the money you just got from your investor. And why is that? Because it's very tough to compensate the risk of a very early stage company with the return you will get, because it's too expensive. Seed companies raise money at price that are several millions euros with almost nothing, and it should not be this. But in line with what I said before, you are almost forced to do that because it's a market practice first, and second, this is a market price, and second, it's to keep people very motivated. So this slide will show you exactly what we are expecting in multiples. So let's take an example. Just concentrate on this. On the left side, the fund side is 100 million. You will get 20% fees, 2% a year over 10 years. Let's simplify. It is 20. And in this portfolio of early stage investment, you will have half of your companies that will be written off. It's not at all what we see with Expand Capital. It's much better, but it's not a seed fund. When you go seed, it's what you usually see. And the survivor, which are half of that, is going to be just half of the money left for investment, so just 40 million. So it means that with a fund size of 100 million, you have just 40 million that will make money. So now this 40 million, imagine that you just expect to get 3x. 3x means a 30% IRR almost. 3x means that you have 100 million, you have to give back 300 million net of carried interest. So carried interest is most of the time 20% of the capital gain, so it is 50. Is it 50? Why is it 50? Yes, it's about the capital gains, absolutely. So it is 50, and then you have the hurdle rate, the preferred return. So it means that first you reimburse the fund, the 100 million fund plus a hurdle rate. Let's say that it is 20% net. So it means that you have to reimburse 100 million, 120 million. Then you distribute to the investors the remaining money, 180, and the carried interest will come on the top of that. So it means that in order to just to go into this scheme, which is probably a basic scheme of venture capital, you need to do more than 8 times on winners. So some people will lose, but those who win will have on average 8.7 times. So if one is 4, the other should be 12. You understand? So it means that when we look at companies, and here you have a portfolio of companies. Each company has a specific profile, and on the right side, it is what you can get as the best expectation, the best if the company overperform or does the plan, which is almost never the case. So let's say the blue curve, dark blue, you can do up to 16 times the money with a valuation you set, 16 times the money. But on the left side, it can go bankrupt. So for the blue one, it's 10% bankruptcy possibility with 0x. But for the light blue, it's up to 60% bankruptcy probability. So it depends on portfolio. So by combining those curves, you end up with the one I showed before. So Now, in order to calculate and to be able to do that, you need to set a value. And value, there are a number of definitions. You have the pre-money and the post-money valuation. And among the pre-money valuation, it's fully diluted or not. Fully diluted means if we exercise the stock option plan. But you also pre-money if with the existing stock option plan, but with another, the adjusted means that you have to issue options before the round of financing in order to motivate the employees that were not served by the founders with free shares. So you need to adjust that. And you also have the post-money, which is the same, but after the money. So in the term sheet, when we talk about pre-money valuation, one of these terms is going to be used, and it depends on the term sheet. So it doesn't have the same meaning. Sorry, Umaya asked a question and I didn't answer. Could you give some background on the carried interest? So I think it was discussed, I hope it was discussed presented by Jérôme, but just carried interest, this is a standard scheme to motivate the managers of funds, and you give them 20%. It is a standard in VC. 20% of the capital gain, assuming that you have a minimum IRR or a minimum multiple, and if it's above that, then you get carried interest. So you get the kind of, it's not exactly a bonus because you invest. The standards are between 1% and 2%. Even it could be a little bit less, but let's say between 0 point something and 2% of the fund. So a fund of 100 million will have an investment between 1 and 2 million of the management team, and those shares are kind of preferred shares that will get a kind of lever effect. So now I will continue to explain the pre-money valuation. So pre-money means that it's before the round. Before the round, on the left-hand side, you see the founders do have 75% of the company, 20% for the angels, and 5% of stock option plan. Stock option plan, so it means we are talking about pre-money fully diluted with existing stock option plan. On the right side, it is what is going to happen after the funding, after they have raised money from a VC lead and a VC follower. So they do take, let's say, 10% of the company, and they asked to issue additional stock options, stock option plan 2, in order to make sure that the employees do have something like 10% of the company after this funding. For sure, the founders and the angels and the existing stock option plan was diluted by 20 plus 10 plus 7, so by 37%. This is the way it works. Yes, so it means that the pre-money adjusted pre-money means that you have to issue 10% before. So in the valuation, you have to dilute everybody by 10% to issue 10% of stock option plan 2 in order to get 7 after this round of financing. So VCs are quite good in setting things a certain way to prevent valuation to go up. So by injecting stock option plan in the pre-money valuation, it reduces the price per share. So valuation is also going up for sure with the growth of the company. At the very beginning, it doesn't work that much, but there is a kind of crazy phase when the company is promising a lot, but most of the time it's returned to normal or even to something which is very tough with a kind of blow-off phase before returning to something median. So it varies a lot between Series C, Series A, Series B, and it is what I could say it's about market pricing. So now let's go to the calculation. So is there a magic formula? So you all know the NPV, but the NPV doesn't work with startups because we don't know the R and we don't know the N. So we don't know what the IRR we would like, and we would like the highest. So it's not a debt. So we'd like the highest IRR. So could be 20%, 30, 40. The more I can get, the better it is. And N, you don't know in how many years you will get out of the company. So it doesn't work this way. You cannot use the NPV for a startup. So I put together a kind of system that shows the way it works in reality. So I told you that for succeeding companies should be over 8 times, let's say 10. And you will hear sometimes that VCs just want to do 10x, 10 times, and justifying what I just described before. With doing 10 times on good companies, you will be able to do 3x your fund, more or less. So FV is its final value. So pre-money, the pre-money should be, so you take the final value. Let's say that a company could be worth 100 million. You divide by 10, so 10 million. And there will be dilution with several rounds of financing. Let's say this is the P with DIs, the dilution that will dilute to 40%. So the right part is 40%. So you are 10, 40%, it's just 6, and you invested 1. So C0 is 1. So the pre-money should be less than 5 million. Less than 5 million. If you do less than 5 million, maybe you can do 10x. And in addition to that, so after that, it's a question of negotiation. But in addition to that, lead VCs would like to take most of the time more than 50%, but it should always be a minority stake, less than 50%. So the stake should be between 15 and 50. So it means that if you put 1 at 5 million pre-money, you have 1 divided by 6 as a percentage. It does work. But sometimes, if it is 0.5, let's say, in that case, pre-money cannot be 5. It has to be less than 5, maybe 4 or 3. This is the way it works. So is there any question on that? It's not very simple to understand, but I hope I explained it quite simply. So the way it works now is the following. So you know that there is a kind of maximum. So you estimate what could be the pre-money valuation the way I did. So let's say 5. Let's say 5. Then you imagine a number of scenarios. Let's say you go public, the company goes as a grow slowly, a company has a fast exit. You have a number of scenarios possible, and you estimate the terminal value in such situation and the proceeds according to the liquidation preference that we will cover later. And then you get a multiple. You say in case of IPO, you will do 10 times, but in case of a trade sale to a local corporate, you will do 5 times, let's say that way. And you put a probability on that depending on the company, the vintage or the economic situation and everything. You combine those scenarios and you get the pre-money valuation. I will skip that and show you directly the scenarios. Look at what is shown here in the table, in the tables. So you imagine what is going to be the multiple, like the management case give you a 10.12x as a capital gain in 2024. But when you change the assumptions and you are much more prudent, and it's going to be 3.7x, assuming that you have a more than 5x, 5.46x multiple on revenue at the exit, because it is in that case, it is the market multiples on revenues, what you see with the comparables. So it could be between 3.7 and 10.12. And then you put, so those are two scenarios, but there could be more. And in the table on the bottom, you see 6 scenarios that are weighted with probabilities, and you have dilution as well, which is written. So by doing that, you end up with a profile, which is this one, a profile. So don't look at refinancing in case of refinancing, but let's say current. In that case, you can do at best 6 times something, and at worst 0 with a blue line. And you have a number of different possibilities in between. But the average in such situation is just 1.9, which is very low. So when we end up with a 1.9x means that the valuation you thought was much too high. So if the 5 million we discussed before, we end up with 1.9x, we just see that it's not possible. It should be 2.5 million and not 5 in order to have 4x, for example, in average.
Alan, can I ask a question about
Yes.
your probabilities of economic success on the previous slide? Are they based on individual companies and you change the variables, or are these medians that you just numbers that you use as standard?
No. I think everything. So which number are you talking about?
Your probabilities living death to big
no,
success.
the probabilities it changes with each and every company. For example, if you have a super connected entrepreneurs that did it 3 times already, serial entrepreneur who knows everybody, it is very likely that the company would be sold early. So it means that it will start, it will bring the company to a valuation of 50 or 100 million and sell it. Some situation like the Elon Musk will wait until it is worth hundreds of billions, but it depends on people. So if a company is sold fast, you will have a lower expectation of return than if the company is sold very late. So it depends on your judgment on the companies and the founders, and your experience for sure. I would say the market practice, so the bankruptcy, for example, stuff is something you will, we see when we meet entrepreneurs, we have a good feeling about the bankruptcy situation. Bankruptcy means when the entrepreneur is not able to raise more money to survive. So he goes bankrupt or is not able to make revenues. Yeah, so this is what I said. So valuation should be adjusted after that, and you have to match that with let's say with the expectation of the management of your own LPs, the shareholders, and if it goes, then we can go to a term sheet. Otherwise, it's just impossible. So usually the valuation is the first thing you check before doing anything else on the term sheet. So now about liquidation preference, because it is an adjustment, Because sometimes you have very famous entrepreneurs that just say, guys, if you want to come in, it is 100 million or nothing. So it's not negotiable. So if sometimes it happens, VCs are quite experienced and can come with a number of weapons in order to compensate such a stiff and not flexible position. And look at what happened to this company, Outbrain. So it was published somewhere, but all what happened in the rounds A, B, C, D, E, F, G, with the ups and downs and plenty of provisions that depend on the round, about the type of convertible of shares, convertible rounds, up round, down rounds, weighted average ratchet, full ratchet, depending on the situation. So we'll come on that just later. So when we are not happy as an investor with what we see, we like the company, but we dislike the valuation and the existing provisions for the investor, then we put additional clauses on the top of it in order to make it fly. So start with the liquidation preference. So this is, I name it the anti-crook provision in order to explain it to the founders. Let's take this example, and it happened to a VC I know. I think it's something like 30 years ago, when it was not sophisticated and there was no liquidation preference in deals. So investors invested in common stocks. So in those situations, in this situation, imagine that somebody raises 1 million at 1 million pre-money. So I'm not describing what I see that, but explaining you an example of the anti-crook. 1 million and 1 million pre-money. So company has just a few pages of business plan. There is nothing spent. So you have 1 million on the account, and the founders still keep 50% of the shares. In that situation, he goes to his brother and sells the company 1 million. Sells the company, let's say 500K, and because there is 1 million on the account, so it's easy to sell it 500K. So the brother pay 500 and get 1 million. So he made 500K of capital gain instantly, and with the 500, the check of 500 that you just get, you go to your investor and say, it is 50-50. It was our deal. So you get 250 back, and the founder get 250. So it's a kind of terrible situation on which you can screw your investor very easily with such situation without liquidation preference. So liquidation preference says, when you sell the company and before sharing, first you reimburse the money to the investor. So in that case, it would not have been possible to screw the investors in what I described before. So they have a number of ways to deal with the liquidation preference. The two main ones are what we call the double dip, or the participating preferred, or the single dip, or non-participating preferred. It means, in the first one, double dip, it means that first you reimburse the investors, and then you share the remaining part pro rata. In the single dip, is that either you take the money you invested, or you take your pro rata. So it has two different curves. I prefer the left one. Most of the time it's better for VCs. All the time it's better for VCs. But there is no plateau, because the plateau that you see on the right could have a very tough implication or impact on the way the way people think. And due to this plateau, there is how do you say? There are side effects and conflict of interest when you take decision for the sale. When it's on the left-hand side, it's much easier to negotiate. So I see half of the deal with the left side and half of the deal with the right side. So this is the way it works with liquidation preference. Now the ratchet and washout that could result out of that. So ratchet means if there is a round of financing later that comes with a lower price per share, then you compensate me as an investor with everything, all the shares I should have get if I had paid the price of today. And it is done when it's a very high price. So it's always done, but it is very risky when the price is very high, and it prevents as well entrepreneurs to screw some of the investors by having them pay a very high price when the company is not worth it, and then doing another round of financing at a price which is very low for your friends, for the friends of the founders. So it happens several times to have this situation with the angels paying a very high price, and then you go to the investors, and the investors, the VCs, professional investors, pay a lower price. And most of the time, angels are not sophisticated enough to have planned a ratchet clause, because it was through a convertible, or it was through common shares, or such things. So I just say that this ratchet, when it is applied, had a very big impact on dilution. So we always advise that the founders don't get crazy with valuation, because full ratchet, in that case, would be damageable if one day it does apply. Any question on that, on valuation? I'm very happy to tell you more. In terms of market price, now I told you that we do some calculation, but there is also the market price. And the market price varies over time. Valuation went up in the last, let's say, 10 years, a lot. Maybe it will go down later. And when whatever the round, dilution is going to be between 20 and 40%. It means that even if the company is at early stage, it could be at a high valuation if they raise big amount of money. So a company at a very early stage could be worth 10 million because they raise 5, and a company at a later stage could be worth at also 10 million because they raise 5. So what I'm saying with the calculation is something very theoretical. This is what we do to decide if we get in or not. But the market price in the end is related to competitive situations. And it is likely that sometimes we have to accept, sometimes we have to accept that we will pay something which is expensive. We say expensive because the market price is over what we wrote. I'm trying to now to accelerate in order to let you speak, ask questions. Corporate governance and veto rights. So it's absolutely key that some of the decisions should be taken with the veto of the investors. Why? Because most of the time investors are in a minority position, and without veto rights, all the decisions could be taken by the founders and trying to screw or bypass or whatever with the investors. So what is usually done with veto rights. So this is a forced sale. It means that VCs don't want to stay here forever. So after 5 years, there is a kind of right of the VCs to accelerate the sale of the company. Sometimes it's a liquidity event, so VCs could just stop a sale. Not always, but you see that sometimes. The drag along means if, let's say, 68% of the shareholders want to sell, the others are forced to sell. So sometimes there are situations where you can screw investors again with this situation, and it is usual to have veto of investors. So it means that all together they can block a sale. Having, for example, in the situation, 33% of the company, and having 33% could stop a sale of a company. Drag along means, yeah, I told you. Creation of new shares, for sure, if you have preferred shares, and if founders decide to issue new shares at a very low price, and in which you have a 10x liquidation preference, or whatever, things that are completely crazy, it is blocked by existing investors. And last thing, it is the board composition, which is most of the time in control with the investor to make sure that the board is not shifting to a situation where there is no more voice for the existing investors. So there is Christophe. Hello, Christophe, asking a question to us. What is this? Do you have PPM template? Yes, I saw that at the beginning, Christophe. I will come back on that later. So reps and warranties. So this is a tough thing. Reps and warranties are protection again for VCs. And what is the main reason why we have reps and warranties is to just get access to hidden information. By having people guarantee a number of things, make you sure that you will know everything or almost everything. And I will give you an example of something that happened to me. It was a long time ago. At the time I was co-leading a round of financing in a company, and it was at that time 7 million. I remember quite well, 7 million, but it was 20 years ago almost, so it was a big amount of money. 7 million, and we asked them to disclose everything. Please tell us that you don't have trials with your employees. Tell us that your accounts are certified. Tell us that you have no debt except the one that you disclose here, and no off-balance sheet things. And they didn't want to sell, saying that we asked them to pay several millions if they were lying, and they say, no, it's too expensive. We cannot take this risk because we don't know blah, blah, and blah, 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 blah. And a few hours before the closing, it was the last point to finish, and they just disclosed something which was an off-balance sheet commitment to buy advertising on a very famous online media, which was at the amount equaling something like 90% of the money what was injected, and it was not disclosed. So the money that we would have invested would have gone directly to the accounts of this big media. And it was not at all in the business plan, but it was signed. So they disclosed that, and we stopped, we passed, and we broke the deal. So it is absolutely key for us to get that. It's almost never exercised because we know that things are tough. We don't know what's happening in the future. We just want people to say the truth. So this is the main purpose. So Daniel is asking about veto rights. Do you see in practice more operational veto rights, for example, large investment acquisition? Yes, for sure. You have a long list of veto rights, which is 10 or 20 that you would see in the shareholders agreement, and everything which can bypass the liquidation preferences, for example, is part of the veto rights, for sure. So I'm coming back on the reps and warranties and go to the corporate governance. So corporate governance, it's tough, just because we are in a situation where we partner with entrepreneurs as VCs, and in order to do the deal, you have to fall in love a little bit. You fall in love with the project, and you like the founders, you fall in love with the project. Sometimes you can fall in love with the founders, why not? But it's not recommended. But it's tough because we married, but we have our interests are not totally aligned. Not totally. Most of the interests are aligned due to the liquidation preferences, but sometimes you have very tough situation, like in a real couple. Very tough situation. It's always much more difficult to what entrepreneurs do expect when they get in. This is why VCs like very ambitious entrepreneurs that are a little bit crazy. I mean that they don't see in reality all the risks they take. Like going to a rodeo like this one. So if you are very smart, maybe you will not go, except if you are a world champion. But most of the entrepreneurs are not world champion, and it's tough for them. So what can be done by VCs? VCs are the clown which is on the left-hand side. We have to support. We know that it's going to be tough, and we have to be ready to support materially and morally or intellectually the entrepreneurs, because they will go through tough times. And I've seen burnouts, I've seen people super discouraged, and the main added value is to make sure that they don't leave the boat, because we need them. We put money on their heads. So the board composition is also a mix of founder and investors. Sometimes so most of the time we try to limit the size, but it's very tough, because it's like it is usual that a number of followers would like to become board observers. So it has a tendency to be big, but it should be quite limited. Question which is always the case: should the CEO be a board member? It should not, I think, but most of the time it is, because they just want that, and it's more important for them than the valuation to stay on the board when you are a CEO. But it's not necessary, and it has a number of drawbacks, and I don't have time to go in depth with that. And the chairman is a must-have. Is a must-have, because it protects the CEO. And having an independent chairman, you extend the life of the CEO as a CEO, I think, by a factor of 2, just because it protects him to just fight with the other board members, because the chairman will do the go-between. So in a minority position, so this is what I said. We put money on the head of the founder, so we need them. I already covered that. And power balance, for sure, until the profitability, the balance, the power is in the hands of the VCs. And once the company is profitable, you see the change of behavior in the company. And now the company doesn't need to raise additional money. So you see the founders that change. Most of the time, they change their behavior and become more aggressive or distant with their investors. Not aggressive, but let's say distant. And don't remember that there are personal liabilities for non-exec directors, so for VCs on board. So I would just finish in 1 minute the takeaways and then go to the questions. Takeaways on the syndications. First, when you get in the VC business, start to be a follower and learn. And it takes several years to learn how to deal with deals. As an LP, you can co-invest with your GP. It's a good way to learn. Co-invest with professional VCs when you are an angel, for example, or a small fund, or a family office, and in any case, syndicate with investors from the jurisdiction, because investing from Luxembourg in Spain, you will see that it's going to be a nightmare, because you will have the apostillas and all those stuff with the notaries that are written in Spanish. And if you are not an expert in that, it's going to be very tough to lead. Second, with the terms should fit with the fund strategy. And this is why you have plenty of different term sheets. Second, the term should be market standard. And there are a number of standards, and the templates I showed you brings most of the standards. And going away from those standards will kill the company, because the company will not be able to raise additional money in the future. Third, all critical terms should be in the term sheet, so term sheet should be long. And if it is possible, signed by all the shareholders, in order to prevent some difficulties when you go to the shareholders agreement, which is 10 times bigger than the term sheet, with many more words and sentences. So if terms were not accepted by all the shareholders, it's going to be tough. And prefer the price rounds if you can. It's not always possible. And third, about corporate governance. So our role as the VC is to support the CEO. Support, not come and as an accountant, look at the accounts and just tell the CEO that it's not good because it's not what was planned. Doing it this way doesn't bring value and just increase the risk of not succeeding at all. Don't forget that we have personal liabilities as a board member. I've seen a number of colleagues in the past being in tough situation for 3 to 5 years after the liquidation of a company, and with the liquidator trying to sue the VCs because he said that actually he was not a board member, but he was the CEO. So we have to be very careful, and most of the lawyers know exactly what to write and to keep you on the right side of the fence. And third, if you cannot bring added value as a board member, you should not be a board member. It's not just to get information. You should be able to think and give good advice from experience. So it's tough to be a board member when you are young, very tough. And CEOs also like a lot when investors do bring contacts, bring introduction to other investors, or bring some insights if you are a specialist of something. So this is, I think, what I've planned to do. And if you have questions, you can just turn on your mic and I'm happy to answer.
Thank you, Alan. Great presentation. So do you have any questions? I think now it's the time.
Feel free. I'm sure you have.
You can always contact Jerome, Rodrigo, and Alan afterwards by email if you have any further question. But I think it's a good opportunity here.
Yeah. So maybe not everything was clear, and if something was not clear, I'm happy to go back on that. Or if you think I just went too fast on a specific point, very happy to detail a little bit more.
So we have two questions in the chat, Alan.
I'm sorry. Let me read it. How do you usually decide jurisdiction in a contract? Yes. So the term sheet, sometimes you see that jurisdiction is the country of the lead investor. Sometimes it is the country of the company, depending on what is the final negotiation on the who wrote this term sheet. But with the jurisdiction of the final documents, it's always the country of incorporation of the company. Always. We have no choice because you have to write the articles of associations, write a shareholders agreement, and make sure that it does work with the jurisdiction. This is why I'm saying just take a local investor that is an expert in the business law, local business law. And then a second question about valuation. Do you stick to the valuation you invested at once you acquired? And how often do you reassess your initial investment? That your initial investment was worth it? This is a very good question. So first we invest at a specific valuation, but as soon as we have invested, valuations start to shift upwards or downwards. It doesn't stay the same. And with regulated funds like ours, we have a CCAR, we have planned, and we do we do a valuation exercise every 3 months in order to look at the value of the portfolio in case of, for example, a secondary sale, a sale of one of our LPs wanting to sell their shares. So it could be done this way. But we do at the same time on our side, we do reassess the value of the company every quarter when there are a number of relevant information in order to be able to discuss about that, and reassessing all the probabilities you have seen, the exit value, and because it changes very fast. This is why we could decide to reinvest more in a company or stop reinvesting, depending on things. Sometimes you will see that the value is there is a new round of financing with a value which is much too high, and we will not reinvest. So there are several strategies with funds. The two main ones are the following. Either a VC invests on an early stage and says that it will reinvest his pro rata share in order to keep his 10% a long time. So he will reinvest money a little bit more each time, but in order to keep 10%. So he will reinvest 10% of the raised money every time there is a fundraising. Or other funds like us that are very flexible, that decide to reinvest depending on the situation. And we don't have this approach. It's another approach that we decided. Daniel said, it's very long. You can talk, Daniel.
Yeah, I will do that. So one thing that I see sometimes for angel investments, and that's a stage where it's very early when the founders come. Very often it's little more than an idea and the people. So there's not a lot of track record or developments that have been done. So in terms of valuation, I wonder how you see that as a professional investor, because I mean, they come up with big numbers and big projections, but obviously there's a high risk that these projections don't come to life. And on the other hand, if you look at a classic valuation approach in terms of cost to recreate, that's almost zero. And my feeling is very often it's like a flat value that is put between 1 and 10 million. And how do you see that as a professional investor?
Yeah, for sure. You're right. When we are at the very beginning, usually it's almost not possible to know what is going to be the output. We can imagine that the company, you can judge that the company has 50% chance to go bankrupt and a 10% chance to be a very big success. In that situation, you need to see how big is going to be the success. So if it's a company that is targeting a single country, it's not at all the same situation when a company is targeting the world as a market. So if the market is big, the potential outcome for success is big. In that case, we are eager to pay a little bit more than when it's a local market. So first, for founders, the more ambitious, the higher the valuations first, because it's just about potential capital gains. And second, as you said, there is a kind of minimum which is related to the dilution. And most of the time, the founders manage to keep dilution at 20% or something each round of financing. And if it is more, like 50%, you will see that in 2 rounds of financing or 3, the founders goes under to the 20% I mentioned. And under 20%, in the end, other VCs will say, oh, we cannot get in because the founders are not motivated anymore. And you have to issue shares for free. So it will reduce the valuation. So for sure, the practice is to keep room for additional round of financing and keep room for the motivation of the founders. Any other question, or are we done? Or do we have time, Evie?
Yes, if we have other questions, of course.
So it would take, to go into the details of all those terms of the term sheet, it would take several hours or even more. You should practice, really practice in order to train. It's another way to learn, but it was just a kind of introduction to what is a deal closing and what is the reality or the theory of closing deals, and especially on valuation. I hope that you understood. Thank you very much. I'm very happy, and I hope that some of you will become VCs, or I don't know if there are people from the family office, from family offices or fund of funds, and I hope you will invest in venture capital, which is absolutely very rewarding for everybody, for you, for your investors, and for the startups and for the world. You know that with Expand Capital, we try to select projects, and we do select projects that have a positive impact on the world, but it's for financial reasons that we have done this fund. So it's not a charity. It's just making sure that what we do has a positive impact.
Thank you very much, Alan, you and the whole team. Thank you all for joining and for your questions, of course. And see you tomorrow for the ESG module by LuxFlag. Thank you very much.
Thanks.
Have a nice afternoon.
Bye-bye.
Bye-bye.